Hello everybody, welcome to the March edition of the OpenCorp Facebook Live Q&A session, the coronavirus special.
Oh, there you go.
Lots of things happening at the moment in property, lots of things happening around the world. I guess the most exciting thing that happened in this office in a week where we've hit historical low interest rates is we had to go and hide the toilet paper because the staff were starting to loot the office, take some home. Got to say, I was pretty astonished to go through Coles and pasta, rice, toilet paper vanished. It's pretty strange.
Gone.
Yeah, that's it. I'm Cam McLellan, and we have a special guest today.
Hi, Nat Ravineski.
Nat Ravineski.
Nat actually caught Chris from our office today walking out of the toilets with an armload of toilet paper, and she quizzed him on what was going on with it, and he said, I'm hiding it in case other officers within the building come and take it.
So it's under lock and key, pretty scarce commodity. I've got a couple of just stray sheets in my pocket just in case I can't find some later. But Nat's here to help us. Nat works as part of our team. She's a relationship manager, helps our clients on their journey, making sure that at all times they're getting the best service they can from OpenCorp.
Yeah, so we'll drill Nat a little bit later on what she does, but more importantly, what that means to our clients. So some of the troubles that they go through, some of the challenges when they're investing, so that people who are watching can understand what they're about to step through or relate to some of those stories.
So what does the coronavirus mean for property investment? Lots and lots of talk about it. And there's all, I guess, differing things you read, different things you see, and depending on where you're getting information, varying degrees of truth in what you're seeing. But one of the things I see as a real positive, but for Australian property, is lots of money coming out of the share market. People like to invest. They might be taking that money across into the property market, place to park their money. Once this crisis is over, you've got the, I guess, Asian Chinese community. They'll be looking more and more so to bring money out of Australia into Australia, where it's more certain for them, again, helping our property market. So there's, although it's a horrendous thing happening, but if we start to look towards the future, what does it mean? Maybe a couple of positives there that we can think about for what happens in our journeys in property going forward.
Yeah, I was talking to Michael Beresford, who a lot of viewers would know, aka Bozza. And we were talking about and the basic concept that 20 years ago, if I said to you, if you bought a property in Melbourne, whatever price it was 20 years ago, and you held it till today, would you be satisfied with that? Obviously the answer is yes. But 20 years ago, if I said buy a property, and I was to say to you, in that time you'd have global financial crisis, September 11s, you'd have SARS outbreaks, mad cow. That's a better name for a virus. Mad cow is a much cooler name for a virus than naming it after a beer. But anyway, if you were to name all the different catastrophes that happen along the way, and then say, are you happy with property prices today? You'd be pretty happy. So I think while coronavirus is horrible, and it's really shutting down a lot of the trade going around in the world, and it will have an impact, let's not be wrong, but the reality is it's not going to impact the supply and demand. So in the long term, coronavirus is not troubling. In the last couple of months, we've seen some great growth across Australia, which is really good to see. So investors are enjoying themselves, I understand that.
I was saying recently, I went to Thailand for the first time in around 2005, don't remember exactly when. People said to me, don't go to the bird flu. Bird flu will kill you, you can't go to Thailand.
I forgot that one.
Bird flu will kill you. Went to Thailand, got through Thailand, not a problem. So obviously there's some things to wash out over the coming months, but we hope that the world sees it through and off we go and back to normal. So Nat, day to day you're dealing with our clients, you're talking about different bits and pieces. I guess overwhelmingly, what sort of things are you hearing from them about their journeys? What troubles them, what keeps them awake at night?
Yeah, I think for most of our clients, the big trouble is first finance. Banks have obviously tightened up their lending criteria. And it's probably the most stressful time for our clients. Once they get over that, they're all excited about settlement, and then it's their unknown about construction. So we're there to try and make the process as smooth and easy as possible. So really we hold the client's hands as soon as they sign on the dotted line. Stacey and I are there to help them through the process. So we'll be speaking to their brokers, making sure that finance is all in place, then dealing with their solicitors and themselves and the broker to ensure that settlement is going smoothly. Once they settle on the land, then really construction of the home. So we're the exciting people that give you photos, invoicing, give you updates. Once the house is complete, then we introduce you to property management and find you a tenant.
I think one of the key bits as well that you haven't talked about there is quality control. At the end of the journey, you're making sure that the house is what it's meant to be, checks and balances are in place, warranties are in order, all that type of thing for people to move forward with the property.
I want to get into, rather than talking about OpenCorp, and I'll keep trying to bring it back because I don't want this discussion to be about OpenCorp service.
Yep.
I want it to be more about what things people go through when they're investing.
Yep.
And what some of the fears are. So, have you got? And I should have prompted you on this to think about it. Tell us some of the fears or some of the real clients who are really freaking out at the start of the journey and how they're feeling. What's some of the concerns that they've got?
Yeah, I think clients at the beginning, they have no idea about what to expect. So, they know they're purchasing a property, but in reality, they're not 100% sure of all the things that goes on with that. And there's so many different parts that go to just purchasing a property. There's the finance, the settlement, the construction. So basically our role is to try and make that as smooth as possible. So in the background, people might not know everything we do, but we're speaking to developers to get finance extensions if required. We're dealing with solicitors to ensure those finance extensions have been approved. Once they've hit settlement, then it's dealing with the builder. So managing the builder, managing timeframes, ensuring that the project's going smoothly. If there's any hiccups, we're the ones dealing with it, taking that stress off the client. And once the property is completed, we manage to ensure that it's up to standard. So we do 2 quality inspections at the end, checking those, making sure everything's okay before we hand it over to property management to find a tenant for our clients.
Now, if we can just jump in, if there's questions out there, please bring them forward. It's a question and answer show. Without the questions, we can't give you the answers. We're looking forward to coming back to you with some answers to your questions.
Eileen. Welcome
Hello,
aboard. Eileen's from Brizzy and looking forward to the show. Hopefully we can deliver.
Stop looking at my screen. I'm driving this thing. Get your face over there.
Hey, I've got to say, today was one of the most enjoyable days, and this is a good example of why property investment's good. So while my property portfolio was outperforming today, for me, while I was doing other things, what I was doing was coaching some serious basketball. So I took my kids' school team, the grade 5s and 6s, and we entered the Hoop Time and SSV Championship. So my girls' team last year beat 2,800 other teams and state champions. I'm taking a boys' team through today, and they went through undefeated. So all the other schools, there you go. No, but very, very proud of the kids today. They did very well. So
let's rename this the Cam McLellan Q&A show about his basketball journey.
Property investing should be about enabling you to do the things you want to do. So while my portfolio is out going and doing its thing for me today, it enabled me to go and do what I wanted to do and spend time with the kids. So let's get back to grassroots. That's what investing's about.
Great article in the paper on the weekend. Not sure if people saw it. It was in the Melbourne paper, so interstate as you might not have. But basically it said that house price growth is earning more than the people living in the homes. To give an example, house in St Kilda East in Melbourne, houses grew by 175,000 per year based on medians, more than the average wage for the area. So what that's saying is, go and get investment property. In the words of Boz, go and get 5 of them, because imagine you've had that, your income times 175,000 times 5, more than you're earning on 5 properties. It makes your journey, enabling things like Cam's basketball hoop time dreams to proceed.
It's all about the kids. It's all about the kids. It's not about me. It's not about me being state championship basketball coach. It's not about that. I don't know if you want to title me that. That's cool if you want to, but it's about the kids. Seriously.
So tell us about your fixed rate journey earlier in the decade, or last decade, Cam. Tell us a little bit about what happened there and how that went and what interest rates are like today.
Oh, so fixing rates. So this is a good one. So people talk about interest rates. Interest rates at the moment are at an all-time low, and I should point out, I personally don't think continually dropping interest rates is going to spur the market on.
You'll take it.
I'll take it. As an investor, it's fantastic. Just keep dropping those rates. But I honestly don't think it's going to... we really need spending to drive the economy. That's what it's going to get down to. And not just a few $1 billion. We're talking 3% gross domestic. So you're probably $60-70 billion is what we need to jam into the economy to really get the economy going. So running a deficit, I think, would be a healthy thing for the government. The Americans get it. It's one thing the Americans actually get with their economy driving. We don't. Our Australian politicians don't seem to get it. But fixing rates, going back to rates, what was it? Early 2008, somewhere around there.
I think it was Rudd got him, wasn't it, around then?
Yeah. So I fixed rates at about 8%. And it was only. I bought a property down in Torquay, just a holiday house, and I thought, oh well, I'll just fix some rates on that one at 8%, somewhere around there.
I think he had a nightmare and he said, I think my dad paid 18% once. Going back to that, and it'll lock him in. I think within 2 years they were down to about 4.
No, it was about 5 months, so we're down to about 4. So anyway, it wasn't a huge amount of money in the whole scheme of things. But fixing rates at this point in time may not be a bad thing, because rates really can't get that much cheaper. So, and you look about the Japanese economy. So a lot of Japanese economists, zero interest rate did nothing for the housing market. So we've really got to look at other things to drive the housing market rather than interest rates. It'd be easy for me to say, rates are good, go and buy property, but I don't believe it's one of the main drivers of the market.
So I asked a broker yesterday after the rate cut, and all the banks passed it on. Good on them. Thanks for listening to Scott Morrison and doing that, banks. For the first time, we've seen investment loans, interest only, under 3%, so 2.99%. So to put that in perspective, you can buy a $1 million house or property, and your repayments are $30,000 per year on that property. It's just absolutely unbelievable to think of it like that. And especially if you go back to when Cam locked his rates in, Cam would have been paying 80-odd thousand a year back in those days. So it really is an amazing time to be investing in property. The other thing we're seeing, despite, I guess, not historical low, but very, very low rental vacancy rates, it's cheaper to own a house than to rent a house currently with interest rates all that. So it's a great time for people to be getting into the property market. There's always going to be tenants, but what a great time to buy a property when your repayments are so low.
Nat, I've got one question for you.
Yep.
If you had a client who was purchasing a block of land and they struck a water table.
Yep.
Does that ring a bell?
Yes. So
does that ring a bell?
Yes, it does. So last year I had a client who purchased a property, and during construction of before they even had
piers,
digging
piers.
Yep. Before they even had their base poured, they'd gone down and hit a water vapor tube thing. Anyway, what happened is it took a long time for that to be fixed, and a very expensive error on the developer side, the builder side. Our poor client was wondering what was going on. We kept him in the loop, and he said to me at the end of it being fixed, if I didn't have you, I don't know what I would have done. Not only would it have cost me over $20,000 to get fixed, which we had negotiated with the builder and the developer. He also said the stress of having to try and sort this out, which took a few months to sort out. He said, I don't know what I would have done. So we did all the fixing in the background. So we're working with the developer, the builder, to fix this vapor barrier. And the project went along. Obviously, we have guarantees in place. We have a bill guarantee if we go over time. He was covered by that, and the project got finished. He got tenants, very happy. Had a second one.
Purchased a second property?
Yep, purchased a second property, which is fantastic because, he was very grateful for all the work we did, because he said, if I had have done it on my own, all that stress and money, I probably would never have built a house again.
So you've got a comment? Sorry.
No, you're welcome to, and we've got a huge amount of questions coming through, but I think there's a list of things which Nat does, and we basically did a breakdown, which I think is important for any investor, whether you're using our services or not. But we've got a breakdown which shows if all of the things that need to happen, so all the individual things that need to happen during finance, during settlement, during construction, during tenancy, and then what Nat and the team do is they take and they allow the clients just to do the nice easy things like signing contracts at the top, and they paddle like crazy underneath to handle all the dramas underneath. That pretty much so you're scrambling like mad to make sure things go smoothly.
Yeah.
And I liken it to investing. So that client there, what's he done?
His name was Paul McLellan.
There you go, Paul. Yep. So Paul, obviously going through that, if he was doing it on his own, would have been, by the end of the experience, would have hated investing.
Yep.
That's the end result. Now, I think I liken it to sort of a baby walking. Do you know what I mean? So the first time, not saying Paul's a baby, but the first time you set out a baby walking and they go and fall flat in their face, it's a terrible experience. You pick them up, you walk again. Investing's like that. So we made mistakes early on in the days, and I think that's why we try to provide these shows to people, is to educate them that there are troubles going along the way. So you've got to be used to having issues come up and battle through them, because the end result, Paul got a property at the end with a tenant that was a good outcome. It was a good property which is going to get good growth and good rental yield, enough to go and purchase again.
Yeah.
If you just go and step through it yourself, fall flat on your face the first time, it's a horrible experience. So investing, I always see, and that's why we love getting our clients together. We had Gun Buy World the other day with nearly 500 clients or families there the other day, so they can get together and support each other on this journey. And I think it's really important to have people around you who are going on the same journey, and I think that's what you guys do really well. So, what
thank
have we got?
Thank God there was a point other than the baby falling over. Nat, I've got some bad news. This person has said that Stacey and Amanda are awesome. You missed
well,
that,
Stacey's number one RM, I must say.
RM, what's RM for those out there?
A relationship manager.
There you go.
Yep.
So you're basically an executive assistant for our clients, is that how you...
Pretty much.
Great way to put it. So a question here from Adam. Hello, Adam, and g'day, Hawley and VK. Thanks for joining. Question from Adam. Quick question. Good one for you, Cam. I'm 23, live at home with my parents. Got 50k in the bank. What do you recommend I do?
All right. Now, while we have an Australian Financial Services licence, advice we give is general and it's not specific to individual question.
Can I ask this differently for Adam? When you were 23, Cam, what did you do? Mm-hmm. And what does your life look like today off the back of doing that?
Yeah. It's probably two things. I think you should skimp, save everything but steal to get your first deposit together any way you can. So what Adam firstly needs to do is go and find probably, and I'm happy for you to send a direct message through and get a referral, because getting a broker who understands. So what you want to do is get a borrowing capacity. How much can I borrow at this point in time with what you've got? So,
and he's pretty close. You're pretty close with your 50k.
50k is getting close to being able to do something, in the Australian market, in a property that's going to perform. You know what I mean? So you can buy something way out bush, and I come from the country, so I'm allowed to say way out bush is a terrible investment. But getting close to 50k is getting somewhere near the realm of being able to do something reasonable in the capital city. So working out your borrowing capacity first of all, then doing anything to be able to get your borrowing capacity up to the point where you can buy something, and buying a property with a high enough yield that it's going to cover most of the holding costs.
So you were 23, you had some choice in front of you. What did you do?
All right, so, and I know there's been some talk in the paper recently. I think it was Joe Hockey who came out and said Australian kids nowadays are lazy because they won't go and get multiple jobs. And he got absolutely slammed in it, saying, eating smashed avo and that sort of thing is destroying the younger generation. I didn't go to, and part of me actually agrees with him. I had 3-4 jobs some points in time when I was trying to get that initial deposit together. So I worked stupid hours over a number of years trying to piece together anything to build my portfolio. I also never went to a cafe until I was probably 25. I don't think there was no eating out back then. So it was a different lifestyle. Yeah.
So long ago, Cam.
You go to a cafe and you're getting a couple of dimmies and a Chico roll and you're getting out of there because you don't want to touch anything. That's how disgusting they were. And so it was a different environment. Nowadays it's all about consumer spending. So we want to have big nights out with friends, fancy dinners at fancy restaurants, because MasterChef says we need to do, and we want to eat smashed avo all day long. My daughter goes out, she's year 7, the other day she said, I want to catch up with my friends before school and go for breakfast. Like, come on, seriously. So they're going to cafes and having smashed avo before school. That's happened once, it won't happen again. I like to say it.
But I think that's
so we're getting to the point, back to the point. So working at your borrowing capacity, skimping and saving and working hard, making sacrifice, delaying gratification. So I also sold my car, HQ at the time, I wish I had that car now, it's probably worth about 90 grand. I think I sold it for 4.5 at the time, put it together with a bit of superannuation that I'd put extra into, so I could actually draw that back at that point in time, and that was the deposit for my first house. Not having a car, it was about 8 or 9 months where I rode a bike just to work because I couldn't afford a car, and then I got to the point where I had enough money to go and buy a car again. So I sacrificed and delayed gratification to the point now where I don't have to come to work because my property portfolio is working. I can go and coach kids basketball because that's what I enjoy doing.
So I think that property, Cam, when you were 23, and numbers might be slightly off, might have been 143,000. Am I right?
No.
137?
143,500.
And knowing where the property is, I'd suggest the property's worth 700,000 or 800,000 now. So the answer to your question there, Adam, absolutely firmly, is do whatever you can, as Cam started that answer with, to get your deposit up, whether it's asking your parents, selling a car, getting a personal loan, whatever you got to do, get your deposit up. And as I said, you're very close to the number and it's worth talking to someone about your borrowing capacity. And from there, you find the right property that grows in value. You then buy a second property, third property, ongoing. You're young, you're lucky, the future's in front of you. And you've got a lot of capital growth to happen in your journey. And one of the things that Cam and I heard early when we were young, just chill out, boys. You're right. You got time on your hands. We weren't listening to that because we were absolutely.
So what we were laughing at was Al's old man Steve. So we were very lucky early days. So we had a mentor to guide us. So the first property I purchased, I was earning 22 grand a year at the time. And the first property I purchased, 3 months later, by the time I'd settled, it had gone up about 40, 45 grand thereabouts. So it was a big light bulb moment when I realised I'd doubled my wage in 3 months. Now, I was lucky that I had someone who was a serious property investor to guide me. So I was basically shoved into this, taken to the real estate agent office and said, sign this. So, and the thing I was laughing at before is we were so hungry. 3 months later, I'm out buying my next property. So straight into it. And my portfolio grew really quick. And Steve just kept saying, boys, just relax. You got time on your side.
Yeah, we're like a bull at a gate, to phrase
when you're young. No, you don't want to hear you got time on your side.
And
you want to do it now.
I feel a bit like an old man now because I look back at those people.
Got a few
people
greys.
your age.
Quite grey there if you look on the side there, isn't it?
I look straight. I just look straight. And I look back at people your age and you're rightfully doing the right thing, but my advice to them is also slow down, enjoy the journey, but make sure you're safe in what you're doing. So the other part, I guess, to what we do and what we focus on is minimising risk. So lots of risks out there, lots of different ways to make money in property, but it's about finding the one for you that limits the amount of risk you're taking and gives you avenues to get out of any situation throughout that journey.
What question do we got now?
We are just waiting on some more questions. Please keep shooting them through if you've got them.
All right, we have one there from Holly on what type of market is at the moment. The concept of what market it is at the moment. So is it a rising market? Is it a slow market? Is it it's a very and I printed out some stats here, and Bozza, who's our in-house finance expert,
You're a stat man,
analysis. Yeah, I am a stat man. I printed out the in-house analytics report that we send around, and when we piece together, so we've got an in-house analytics team, we have a huge amount of different economic and property reports, and we bring them in and analyse them on a monthly basis, and we go through, and what we look at is what's happening at this point in time. What I always challenge the team is when they put all these stats in front of me, job growth and vacancy rates and a plethora of different information. So what? I challenge them. So what? What does it mean? You're telling me what's happening today. So what we want to do in a future episode is bring a couple of these experts in, and we'll put the challenge to them and try and piece together so you guys can try and understand how we cut out the white noise. Yeah. So if I answer the question in what type of market is it at this point in time, in previous markets and prior to 2017, when the market dipped a bit across our capital cities, which was a manufactured dip by the government, it's fine, that's what they needed to do at that point in time. Prior to that, the market, the way I saw it, was a top-up market, so it was pulling prices up from the top. So the top-end prices were high enough that it was pushing up. Now that's not a long-term strong market in the growth, in the sense of growth. What we got, and when people talk about how do you really judge whether the market's got value in it. Are we in a boom or a bust, or what's the market doing at this point in time? So getting back to the point, how can we tell what's going on in the future? Through the last 2 years, you could purchase property at some points lower than what it cost to buy the land and the wholesale cost to build it. Now, when you've got a market like that, you know that prices cannot be sustained at that low level. They'll push up. So what we've got now is a bottom-up market where the huge amount of people coming in can afford the property at the bottom of the market. Now that sort of groundswell there gives a much more sustained and long-term growth in the property prices. So what type of market is it? It's got a lot more legs in it than it did previously.
And a good point there. I looked at, one of the analysts called me over yesterday and said, look at this area I'm looking at. And he found me 3 blocks of land with permits for some houses on them. We couldn't have built the houses and bought the land for the price that other houses in the area were selling for. So what they told us immediately was that there's going to be growth in that market, because just to build them, buy the land, build them, we're already well above what other existing stock was selling for, telling us straight away that there's going to be some growth in that market. So it's a really good point, Cam. I've got a question here from Ben, and it's for Nat. Mm-hmm. Nat, what percentage makes up the clients you're dealing with in their 20s, 30s, 40s?
You probably get about 10% in their 20s. 30s and 40s are probably where most of our clients are, so might say about, 60%, and the rest are 50 and above. So our client base is not generally the same. We have a wide range. So you've got your young 20-year-olds that have been able to save some money, that purchase properties. You've got your mums and dads in their 30s and 40s, or single people. looking to purchase a property, and then people in their 50s that have had their family looking at retiring and purchasing some property. So it's all over the shop.
Yeah, if I use a bell curve, and there's obviously outliers at the lower end, early 20s buying, there's people in their 60s buying.
Hang on, I'm really curious to see what you're going to do with this bell curve.
If I use the bell curve, what we find is that there's two distinct main groups. They're 28 to 35, and they're ones who don't yet have a family but realise they want to set themselves up to be ready for a family. Yep. And there's early families with young kids, 35 to about 45. And they're the ones who are the same, have got a young family now, need to get set up, might be school fees, might be education, range of things, but they're the ones who also go. So they're the main ones, then outliers right out to each side.
Yeah. I think people obviously who are watching most of you would have gone through the WOD series on our website. So we just finished 300 episodes of the WOD series.
They're very impressive, I hear.
What's that?
They're quite impressive videos, those WODs.
Here we go.
Tell us more about them.
No, it's very relevant to what Nat mentioned before. So, and the question that came up. So back in 2000 something, Al and I were at my holiday house down at Torquay, the one that I paid too much with interest rates for, and we were sitting around having a beer, and we wanted to. There was nothing in the market that provided clear advice, small sound bites that people could absorb, small lessons on property, and slowly watching a small amount each day build their arsenal of their own investment knowledge. So we created the WOD series. They went pretty nuts, but they were fairly general. We got to the stage now where, as Nat's talking and dealing with thousands of clients now, really we broke it down. And if I use a really basic example of releasing equity from your own home to purchase the next property, the concept of that and what the video series that we're rolling out now is really specific to those different buyer types, because the concept of releasing equity is very different to, say, a high-powered, time-poor executive than it is to the family unit.
Yep.
Do you know what I mean? So different people have different risk appetites and different things that concern them. Things need to be set up slightly different. So the new video series which we're rolling out will be really specific about, so towards rent investors, towards high-powered execs, and high-powered execs could be anyone from a school principal to the head of a legal firm, but someone who's really time poor. And that's what it comes down to. And then obviously what we call the 50s Up Club, which I'm getting close to. I feel very mature now. So as far as a percentage of different clients, we deal with a wide range of clients. Can give you percentages in those demographics, but really it's different. So if you're within one of those, based on what your position in life is, contact us and we give you information that's relevant to you.
Yep.
Thanks for joining, Costa. Shoot us a question. Love to hear from you. But there's a question here from Michael. How much do we recommend to cover deposit and cost, and is it worth getting a personal loan to top it up?
So how much is it to get deposit and cost?
How much do you recommend to cover deposits and costs? Yep. And then the second part to that question from Michael is, do you recommend getting a personal loan to top it up? Quick yes or no?
No, I wouldn't get a personal loan to top it up. What I'd do is I'd go to multiple banks, get a huge amount of different credit cards and all max those out and put them into a bucket. Definitely don't do that. I've heard investment advisors actually say to do that. Do not do that.
Our mantra has always been and continues to be, do whatever you can to get your first deposit. So that means you sell a car, you tap a mate on the shoulder, you go to your brother, you ask your parents, you work 2, 3, 4 jobs just for a short period. Anything it takes to get your first deposit. Look, I'll be honest, if you get a personal loan and that will get you over the line, that's probably worth doing as well. Sadly, these days with the banks, they probably pick up on it and wouldn't like it.
Yeah, and the reality is that you've got to get some advice on this yourself. So don't take the information that we're generally talking about today. But you're getting pretty close to the mark. So 75k, well and truly, will get you something with a reasonable land content in one of the major capital cities. So 75k as far as a deposit goes.
I spoke to a broker a couple of weeks ago. They said current interest rates, if you're 60 to 70, you're probably in the game. So
yeah,
you've got about that number.
You've got to finding something within the capital city markets is very different. 20 years ago, when Al and I started our investment journey, you basically went from the CBD outwards, and your price points would diminish as you go outwards. Nowadays, there's so many markets within our capital city markets, and this is why we've got a team running through this. So you've got obviously the activity centres with each capital city market. So there's different pockets throughout those which will have different growth and different price points. So shoot us through some detail. We can let you know where and when. If you want to use our services, great. If you don't, hopefully it keeps you safe and go enjoy safe investing.
But we talked about it before for Adam. Key bit is get your borrowing capacity assessed. Costs Costs nothing. Takes, 5 minutes maybe to give the information across. We can assess it, or a good broker can assess it. Make sure you pick your broker wisely. All brokers aren't created equally. And you'll have an assessment pretty quick on where you need to be, where you're at, and what the next steps for you are.
Now, Nat, I know you've dealt with arranging finance for people many times over, many loans. What are some of the pain? So I'll use an example. So the best man at my wedding, 80, years ago we organised a property for him, and very shortly after that he made a good 100 grand once he got it over the line. But during that process he called me and he was really pissed off because the broker had lost his pay slips, not once but 4 times.
Yep.
Yeah. So it was an external broker that had lost his pay slips 4 times. He had to go and get them. Back then it was before iPhone, so you couldn't take photos of things. You'd have to go back to work and ask the payroll person to print out some more and take it back and fax it across. And so we're talking a while ago.
It's painful.
So it was a painful process. 12 months later, he'd made over 100 grand. So, and I said to him, at the time, I copped the abuse. Going, I understand it's painful, but just keep pushing through.
Yeah, exactly.
12 months later, I said, hey, was the 4 hours of pain, wasn't 4 hours, but potentially 4 hours of pain worth the 100 grand you made?
So 30 grand per hour.
Oh, there you go. So Nat, what do people need to be used to when they're going through, to get finance? What do they have to get together? What's some of the pain points they go through?
Banks are scrutinising everything as much as possible these days. More than I was a banker for 10 years, so working.
Were you?
Yes.
ANZ.
ANZ.
The things you learn on this show.
As if you didn't know that.
Let's ask her surname 3 times at the start of the show.
Who is this girl here?
So I work for small business banking, and obviously we did some lending. But these days banks are crazy and they're asking for your kidney almost. So people need to be prepared that they need to have pay slips. They're going to question everything in your statement these days. So you need to be able to mitigate what your spending is. That's probably the biggest pain point for our clients at the moment.
So looking at the last 3 months of spending, generally?
Last 3 to 6 months of spending.
Tighten your belt for 3 months prior to loan application?
Yeah, because they will look. So if you sort of have a plan, okay, I want to purchase, probably behave yourself in the next 3 to 6 months. Don't go out as much for dinner or drinking. But that's probably a big pain point. A lot of clients are saying these days, I can't believe all the things that banks are asking for these days, or questioning everything. And it's not just someone earning 50 grand they're asking questions for. It could be someone earning 500 grand. So the same questions being asked depending on what income you earn. Just be really prepared. The bank is going to scrutinise everything. But, for that hour or two that you take to have to answer a question, think about the long-term excitement that you're going to get when you actually purchase the property. So a lot of people in finance get a little stressed out. They might get a little deterred. But once you get over that hump, you're laughing. So. And
I'm going to give a real live example that I heard of. Young kids nowadays, so when I'm talking kids, I'm 46 now, Jesus. When I'm talking kids, I'm talking 20s sort of thing, and no disrespect to people in their 20s, but sometimes
I think it's 47.
Yeah, no, it's 46. I know definitely 74. So do the math.
Next year's 21.
Nat mentioned the banks go through line by line of your statement and ask you questions on what's going on. So if you're a 20-year-old depositing money into your friend's account because you owe them money, don't put the description as money for strippers. Okay? So this is a live example of happened and a loan was knocked back because their friends had written this in there, and the banks see that as a blemish on your character. So think about having a look at your statement before you submit it in. Now obviously that's not a wise move, and just look after your friends, seriously.
Let's keep the questions rolling because we're very keen to answer them, and the more you shoot through, the more we can answer for you, obviously. Price growth, Cam. You were last year in May, if I recall. I mention this every show, I think. Last May, someone said, Cam, you got your goggles on again because you're always saying buy property. You're still saying buy property. The market's come down. Why are you saying buy property? And we talked about your rose-coloured glasses. Do you want to talk about maybe just reiterate what's happened since last May when you were told why would you buy property in May?
Yeah, we'll go through the last January was in the 2 major capital cities about 1.2-ish% growth off the back of about between
2 months ago.
In Jan,
Yep.
Jan. So the stats are sort of a month behind. We'll be able to get those very shortly. But that was off the back of a quarter of around 5 or 6% growth of the quarter in Major 2. If we look at Brizzy, which I know everyone's been waiting for Brizzy to kick off, 0.5% off 2.4% increase. Now, obviously, the jobs is the most important thing in Brisbane. So Brisbane's had the largest net migration from other capital cities than any other capital city. So that sort of pressure, we're looking forward to some serious action in Brisbane in a short period of time.
Yeah, so people have been talking for a little while that Brisbane's ready, the last couple of years, let's say, but people are now saying every single duck is lined up. Maybe in the past there's 4 or 5, or there's 3 or 5 ducks lined up. There's 5 ducks lined up and absolutely ready for the market to grow.
Yeah.
But I think the really interesting thing is, and we say it to everybody, when's the best time to buy a property? The moment you can afford to. We talked earlier about do anything you can to get your first deposit up. But for those people who last May sat there and went, you know what, there's an election coming, maybe it's not the right time to buy a property, this is happening, that's happening. There's probably never a great time to buy a property. Right now you could blame the coronavirus. Buy a property when you can buy a property, because those people have made 10 to 15% on their money, on their investment, not on their money, they probably doubled their deposit they put in, just by buying a property when they could afford to buy it. So the point to that is, let's not sit around waiting for someone to ring a bell and someone to shoot balloons and a skyrider to go around and tell you to get and buy it. The moment you can buy one, you buy one. Cam talked about these fluctuations up and down, and what do you say, 9/11, the Gulf War, GST came in, you name it.
The Gulf War.
Yeah, it's a big one. There's all reasons not to buy a property, but if you'd bought a property in 1980, well, you've sat there pretty happy till today because it's gone up in value. Real example, my parents paid $32,000 for a property in 1977, property I grew up in. It's currently worth $800,000. So that's just letting time take care of the growth in the market. Doesn't matter that there was all those things that happened in between. They owned a property, they held a property, and that's the growth you get out of it.
Now, as I said early on, you've got to be discerning with some of the numbers that you hear. So if I look at, so we've told you at a point in time, here's what's happening at this point in time. So once again, if I gave you the numbers of growth and you looked at it and said, and you looked at the growth factors and the ones that were higher attracted you more to those markets. If you look at the example of Hobart, which has had nearly 16% growth in 2019 alone, maybe you'd be attracted to that sort of market. The reality is you've got to look at obviously the future potential population growth in those areas. So Hobart, Adelaide, Darwin, while we look at those markets, obviously they don't attract us over the long term at this point in time. I've got family in some of those markets, so no disrespect to the markets, but I look at capital cities that have got long-term population growth forecast. The beautiful thing in Australia is we've got the Housing Supply Council, which the government set up to tackle the problem that Australia's got of having a housing shortage over the long term. Now, some of the numbers that come out of once again, I love the numbers that come out of it, but once again, looking at the numbers, being discerning, the numbers that come out of the Housing Supply Council, I go, all right, well, if the numbers don't look dramatically bad, then maybe the Supply Council wouldn't be around. So, you've got to look at everything as a pessimist a little bit. Not that it becomes analysis paralysis, but the reality is Australia has a Housing Supply Council set up by the government because we've got long-term undersupply of housing, which is a great thing in our major capital cities for investors.
A couple more questions that come through, and keep them coming. Does OpenCorp recommend properties that are not new?
I've purchased a lot of properties that are not new.
I guess the question, another way to ask that question is, why do we recommend new property to people? We talked before about risk mitigation and all these different steps to make sure that when you're buying a property that it's going to be successful for you. What are some of the key ones that make a new property tick a lot of those boxes?
Yeah, right. So I'll answer it two ways. At OpenCorp, we won't show a property to a client unless I've scrutinised it to the point that I'd be satisfied adding it to my own personal portfolio. So that gives you the crux. So while I say I've purchased lots of established houses in the past, in the last nearly 15 years, I've only purchased new properties. And the reason I did that was that the way to build wealth is to hold the most asset for the least amount of money out of your back pocket. That's really where it comes to. So Al mentioned before, St Kilda prices going up X amount. I looked at purchasing, Felicity and I looked at purchasing property in Elwood, which is next to St Kilda. Cool areas, great style of living. Prices are worth fairly high, but the reality is when I looked at purchasing that and we were moving in there for a year, we decided to rent and we purchased or 2 or 3 properties in the outer suburbs for the same amount of money. So we had 2 or 3 properties in the outer suburbs that gave us a lot more rent. So we're holding about 1.5 times the asset value in an outer suburb area that was giving us much more rent, costing us nearly nothing to hold those properties out there, as opposed to an area. And those outer suburbs that we picked actually outperformed, that blue chip suburb. So, but if I go down to, once I've narrowed that down to the point now where we've got our strategy, and happy to share the spreadsheets and check sheets for you on why we purchase those properties and what to look for in the capital city markets and the growth corridors, and then to find the optimum size and quality property. The key reason is you get maintenance issues, you got builders warranties, but the big one is when it comes down to holding the most amount of asset for the least amount of money out of your back pocket. We like growth properties. You don't go into properties going, I'll buy it because it's negative gearing or it's cash flow positive. That's ridiculous. I hate companies, hate's a strong word. I dislike companies that sell on the fact that they are negative gearing properties or they're cash flow positive. You should expect both. Yeah. So buy a property that over the first few years you can use the depreciation, which is really, really a good tax benefit in those first few years, to cover the holding costs until the rent chips up and starts to cover the cost and hold that property. And you can sit it aside, that one's there doing its own thing, go and get another one. So yes, the properties I put in my portfolio are new.
So I'll ask some of the key risks when you own an investment property, and you tell me whether new or older properties are most likely to overcome them.
Just like a...
Can't get rent.
Can't get rent, what, at all?
You can't. Well, you need rent. What's most likely to rent?
Yeah, okay.
New property or old property?
New property, old property. What's going to get rented out first? New. What's going to get a higher rent? New.
Severe maintenance issues. We heard of a client recently at an older property, spent $25,000 within the first 6 months of buying it on a new piping and water or whatever it was. So controlling your cash flow in terms of maintenance, new or old, what do you think?
Yeah, there you go. New or old.
Depreciation, what gives you the most there?
New is fantastic.
The list goes on. So the question would be, do OpenCorp recommend properties other than new to their clients? No, we don't. Properties are always new for the reasons that we're saying there. You're minimising your risks as best you can, you're maximising your cash flow, and you give yourself the best chance to duplicate, go again, and build great wealth behind it.
Next cash.
So I hope that answers your question. Jojo Lee has a question on the best areas to buy west of Brisbane for $450,000 to $600,000.
West of Brisbane.
I'd probably say
there's a couple of growth corridors I like in Brisbane, but when you start to get west and south, you need to be really specific. Shoot us through it, and we're happy to be transparent on the exact areas. Shoot us through the details of what you're looking for, price point. But for me to go, the best spot for $650 in that area.
Well, part of what our team do for people is they map out the journey and say, so what's your exit strategy going to look like, and how much money do you want in 10 or 15 years, and how do we get there? Is it buying 4 properties, 10 properties? What does that look like? And then we'll work through going, where is the best place for you to put your money to get you on your journey? So we might sit there and say, look, west of Brisbane, not for you. We should be looking in Melbourne or Perth, or we should be looking somewhere else for you. We need to sit down and look at your situation to understand that, which the team are happy to do. It'll be on your screen. Email Justin and we can do something for you there.
But we're happy to be transparent enough if you contact Justin to get down to the point where we'll go, there's the street I would recommend in that area. Do you know what I mean? We're not holding anything back. If you want to go and do it yourself, that's cool. You know what I mean? So if you think about the concept of getting the best investment property every day of the week, regardless of market cycle, you go through the MAP process, which is outlined in my 4-year-old The Property Investor, and it's got the check sheets in the back. So that concept is about knocking out markets that are not good for investment, then finding the right growth corridors by knocking out growth corridors that are not good, and then finding the optimum size and quality. So while it might sound arrogant that I'll give you the exact street, I still know that we cover our service costs and what we charge clients, because if you think about, we'll say that's the size of a house. You know?
Not very big.
Yeah. It's a miniature house. There's a zoom in it. It's a house for ants. We say that's a house. If we're looking at the optimum size and quality for any area, you've got to look at a lot of different things. Now, you're battling across investors. I'm talking about we're investors. Investors battle everyone else in the market. We battle real estate agents who want bigger, property managers want bigger, tenants want bigger, builders want bigger, draftsmen want bigger. They like drawing big builders. Builders love bigger because they make more money on their non-wet areas, their dry areas. So dry areas, if you whack in an extra media room, builder can put X amount of square meterage on, but it costs them heaps less to do. The reality is investors rent bedrooms. They don't rent backyards, they don't rent media rooms. So you want the optimum size and quality. So where we and Nat and the team get in, you often see them in the office there with tape measures, measuring out areas. And if I look at this and go, all right, so this is a really basic example. If I can carve 500 mil off here, so if this table is in the lounge room and I can have a wall here, or I can bring it in 500, and still the tenant will feel like it's big enough. It's not a dog box, but it's big enough, comfortable enough, but I can save 500 mil off 20 metres. That's round numbers 10 grand you've just saved. The value will value it the same. You'll get the same in rent, but you got 10 grand in your back pocket. So for people who like big and want to go with the flow of going, but if I was living there, just a little bit bigger would be nice. You go, all right, put it this way. When you go to the bank and get your 10 grand cash out, we'll bring it over here and put it in a rubbish bin and then we'll set it on fire. Okay? So we teach people to undercapitalise, yeah? Which is it's a strange concept. Everyone talks about overcapitalising. Let's undercapitalise, yeah? Let's get some equity growth where we need to. And that equity growth we can use to put it into our next place or go on a holiday. So getting down to the point, sorry to not give you specifics, shoot us through the details and we can give you the street we're looking at.
Good question, Jojo. Got a question from David, unless there's any more coming through, this will be the last one for the night. David's question is, do you have in-house financial advisors look into the future and provide a strategy for up to 12 months to buy a property and identify the steps to get there?
No, we don't.
No, not financial advisors, but a big part of what our team do is sit down with you and help you to map out a plan for where you want to get to.
And you're welcome to take that to a financial advisor. We've got an Australian financial service licence that talks about our funds that we do. We can talk specifically about the funds, but not about your personal circumstance.
Yeah, so we'll sort of do a workbook and we'll talk to you about, workbook's probably a strong word, but we'll talk to you about where you want to be, what you want to do, how much money you think you want to live off, what income you're trying to replace, what that might look like in different ways and strategies to get there. Not a financial plan, not advice by any means, but just some guidance on what we've done, how we do it, and maybe some ideas for you to take away.
We'll give you the strategies on exactly how we pick the properties that we pick. And if you say you want something else, go nuts, go and buy something else. We'll teach you about how the properties that we pick and why they perform. We can tell you about the performance we've had of over 1,000 properties over the last decade and how every one of our clients' properties have performed versus the Australian capital city market. And we've beaten it by 37%. So our clients have made hundreds of thousands of dollars, on average more than the average person in Australia. But the reality is past performance is not an indication of future performance. So you need to work out whether our checks and guarantees are worthwhile paying our fee for, or just sitting down and talking to us gives you enough confidence to go and do it yourself. And realistically, we're happy to help people out, but if the education we provide from the books and all the videos allows you to go and invest with confidence and you're safe and it creates a better future for yourself, well, cool, good for you.
So there's a question here that came in via direct message, which is, at what point do you stop buying properties and how do you know when to stop?
Oh, that's a ripper question.
Good question.
We're actually doing a series on this at the moment about exit strategies because there's so many, call them advisory groups. Everyone talks about just buy properties, just get this massive portfolio, but very few people talk about the exit strategies. So we talk about exit strategies, and Michael Beresford, if you look on our website, does a number of different videos and actually breaks down the numbers on living off equity, selling down, the domino effect, so basically building a portfolio, paying down one, letting the rent pay off the next one and paying them down, and usually couple that with with selling a few properties and paying capital gains tax. So there's some detailed video on the website about each one of those. If you can't find them, email Justin. But then I think a lot of people get to the point where living off equity is one really good one, which a lot of clients like doing that. But a lot of people get to the end of life, and depending on how big the portfolio is and how long they've had it, they get to the point where they're asset rich and income poor. So, which is why we created Resi Fund, which basically allows people, so we do with their accountant, a basic calculation of selling down, putting money still back into property, but in property that gives you a high return on a quarterly basis. So you can actually live off that, but you're still in the property market as opposed to selling down and putting it into another form of investment. But
So another way to look at it, when do you stop buying properties? There's two distinct phases of your investment journey. The growth phase. Exit's the third one.
Yeah.
The growth phase, when you're buying all your properties. Your passive phase, when capital growth is taking care of the growth in those properties.
The consolidation phase.
And your exit phase at the end. So to put that in perspective, if you could afford to buy 10 properties today, you'd buy 10 properties today, and you let them sit there, because the 10 properties, let's say they're worth 5 million, because the numbers are easy. In 10 years they're worth 10 million, in 20 years they're worth 20 million, in 30 years they're worth 40 million. Property doubles every 10 years.
Yeah.
So the faster you can get to the point where you want to be, you sit there and wait, watch the grass grow, for want of a better term. Grass grows over time. Staring at it daily doesn't help you, but when you stop and look back at it, it's pretty significant. But you buy the amount of properties you think you need. You stop buying them, because if you keep gearing to 80%, you never get that capital growth and capital growth and capital growth to get the outcome. So if we use that example, you bought 10 properties today, you spent 5 million on them, and in 10 years they're worth 10, 20 years 20, and 40 million in 30 years. Well, you sell half a property, you pay the 5 mil back, and you've got 35 mil in the bank. That's an exit strategy, but you've let capital growth take care of it. You're not buying properties the whole way through. So for each person, the plan's different. You do understand what's your key objective, when you want to be there. E.g., if you're 70, probably not waiting 30 years for the growth. 10 years might be enough. If you're 20, well, you might wait 50 years and imagine happy days. But the key is to buy your properties and then sit and watch them grow. But
so look at the amount of income you got, the time you've got, the type of appetite you've got, and what your desired amount of earnings that you need per year in your retirement phase or your carefree living phase.
And what's the value of money? So there's some other calculations in behind that tell you what a dollar will actually look like in 20 years, 30 years time.
We're happy to give you a sheet that you can go and play with and go and plug all that in and work it out, and some instructions on how to do it. But creating that plan is totally yours or a financial advisor's decision to make. We'll provide a property that may fit your plan.
Good question though. Question here from Jonathan, don't know if you answered this one yet, which is, how do you get to a second and third investment property in terms of loans? Jonathan's got enough equity to get another 20% deposit, but may not pass serviceability. What's your advice?
Serviceability is tough at the moment. Saying that, serviceability can be structured. There's a lot of different factors in serviceability. So, what type of personal loans you got, credit cards is one of the biggest ones, dependence is a big one. So you can't get rid of kids usually, but kids are a big factor in what you've got. Happy if you shoot through, we can put you in touch with a broker who understands property investment. I think, and this is a really good point. So and it's a ripper question, because if you think of brokers, so the standard broker, 99% of what they do is home loans. Primarily place a resident, buy one property, and there you go. The way an investment property broker should set up the structure of a loan so that it allows you to duplicate down the track is about as polar opposite than the standard broker and the banks want to do. So getting that structure right, allowing you to duplicate, and it frees up that serviceability and provides you enough buffers so that if you lose your job for 3 months, you've got enough there and your property portfolio is not impacted. So getting the right advice from a broker and the borrowing capacity and the structure is really important.
And as I said before, Jonathan, not all brokers are created equally. Similarly, a good broker will deal with about 30 banks, and every bank has different criteria in their calculator. It will spit out different amounts they'll lend you. So the key bit to you is get yourself a good broker and work really hard to understand how you can get to that next property, because it might just be a matter of going to a different bank, looking at some different options. And they can also normally tell you, if you didn't have this credit card, if you weren't spending that there, if you had this extra income, then you get it, and you can go over the plan then for how to get there.
Yeah, my first property I purchased, I was knocked back 4 times by banks. I ended up going through Westpac. The main bank that was separate back then, who I won't name, Bank of Melbourne, was the main bank I've been with since 16 provided me with a credit card. I didn't even want it, they just sent it out. I think it was about 4 grand's worth. And I managed it well, I didn't have any money owing it. But that impacted my borrowing capacity, just having a 4 grand credit card, so I couldn't purchase a house. They didn't tell me that when I went to them to apply for the loan. They just said, no, you're denied. I didn't understand that, so I kept going to a new broker, until one said, it's your credit card. No wonder you're getting knocked back by all these banks. I got rid of that. So it was something so simple, but understanding a broker who knows what levers to pull with the banks can set you up so when your application comes through, and as Nat said, it's way more complex now than it was when I was a kid investing. So
and that was
get
a
a good broker.
That's a banker.
That was a banker, and she still finds it confusing.
Yeah.
I think we'll wrap it up there. That's all we've got time for tonight, everybody.
Thanks for joining us.
Thanks for joining us. Nat, thanks for being on the panel.
Thank you for having me.
Hope you got some good info out of Natalie.
Any questions, shoot it through. The living off equity piece is also outlined on our website in a number of different videos. Shoot through to Justin, or also in my For Your Other Property Investor, there's a section on there on exit strategies. and also on finding those right properties. So shoot through a message to Justin and get you a copy of it for free. So
good luck finding some toilet paper. Good luck finding some pasta. We hope you have a good month, and we'll talk to you next month.
Thank you.
Thanks very much.
See you guys.
See ya.